Robo-advisors are all the rage today, but which one should you use? It's kind of hard to know sometimes. There's quite a few out there. A lot of them say something. Maybe they deliver on it, maybe they don't. What's the management fee like? And which one can you actually use, or should you use all of them? Should you use some of them? What should that look like? Well, today we're going to go over a couple of the ones that I'm either using or going to be using. I'm going to dive into each one of them. I'm going to give you a comprehensive overview, and at the end, you'll be able to make an informed decision on how to move your money forward. So first up is Betterment. And you've heard me talk about Betterment before. Betterment's a product that I've used for about the last almost 8 years. God, I can't believe it's been 8 years. Probably the first one in the game where they took your money, they used they used some machine learning, but a robo-advisor is nothing more than using software along with human beings to make informed decisions. And if we look here on the website, the first thing they say is expert-built curated portfolios. So if you want to invest in things like I've talked about in the channel, like Vanguard index funds and ETFs and bonds and cash and things like that, but instead of piecemealing it together into across Vanguard or BlackRock or State Street, you can have a product like a Betterment or like the others I'm going to go into. You can have them do that for you for a small expense ratio or a fee. These are some of the portfolios that they curate for you from day one. You can look at the full list. You can look at the original ones. You can go to stocks and bonds. But for instance, one of the funds that I'm interested in is the Innovative Technology Fund. And if you look here, this is all stocks and bonds. You can look at the historical averages across time. You can look at what's in here. So this is a big one that invests in US and global companies that are driven by innovation. So clean energy, semiconductors, robotics, virtual reality, blockchain, probably more on the aggressive side, but certainly something that if you like more risk, something you could look at. It allows you to do future forward projections on what your money may do. So we're looking here, they give you a projected over 30 years, 783%, 7.5% a year, starting balance 50,000, ending balance 441,000. Now you get into the meat. You go down here and say, well, I gave you 50,000, but what exactly are you investing in? Well, in this case, what they're investing in are these ETFs down here, KOMP. Now, if I click on KOMP, it opens up in a new tab. This is the New Economies Composite ETF. Now, what's interesting about this is it actually gives you exposure, like we said, to those virtual reality, biotech, artificial intelligence, energy, and we go down here and we can actually see what it's invested in. So if I go down here, I can see we've got Coinbase, Teledyne, Snap, Meta, Apple. These are all things it's interested in, that they're investing in. And I can look at their industries as well. So application software, aerospace and dynamics, and healthcare. But that's just one. The biggest holding in this original or this core is VTI, and I've talked about VTI plenty before on this channel. This is a Vanguard index fund that gives you, it could be an ETF that gives you the ability to invest in a lot of different areas of the market. So if we go down here, you have 3,883 stocks, the median market cap, the PE ratio, but this is a great way for diversification, and it tracks the performance of the US total market. So if you're looking for something that's very broad, very general, that's a good fund, and it has a very low expense ratio. So if I go back to the Betterment page, you're actually able to see they're invested in quite a few different offerings. So in this case, you have stocks, you have international stocks, you have high growth stocks, you do have bonds. So in this case, they are allocating a good chunk of your money over into bonds. Now, why, what's Betterment's what's their big selling point? Well, their big selling point is tax savings. So tax loss harvesting. What is tax loss harvesting? Tax loss harvesting, or TLH, is a way to sell securities or positions at a loss in order to offset your taxes in the following year. For instance, if you have $5,000 worth of Apple, and Apple, you bought it in at $6,000, you may be able to sell some of that off as a loss to help offset your taxes going forward. Now, if I go back to the full list of what's available here from a Betterment perspective, plenty of different portfolios you can get yourself into. One of the big draws as well from a Betterment perspective is they have a 0 account minimum. So you can start with $5, you can start with $1, you can start with $100. Those are some big things. The other one, and this is speaking from personal experience, I've had great customer service with Betterment. So if you're looking for that human touch, That's something you won't get with some of the others, where you can schedule a consultation, you can talk with one of their certified financial planners, and you're able to get a robot plus a human being perspective on what you should do with your money. Okay, number two. Number two is Wealthfront. I've talked about Wealthfront before on this channel. Wealthfront, much like Betterment, has been around for several years. Wealthfront, like Betterment, has a $0 account minimum and a 0.25 account fee or management fee in order to manage your money, just like Betterment does. However, things start to get a little different with Wealthfront to Betterment. So one of the big things that Wealthfront does, I think better than Betterment, is they do what is called automatic index investing. And I should mention very quickly, that's for accounts that have over $100,000 or more. So automatic index investing is you're able to invest directly into those funds at a much lower expense. Now, if I go down here, I can see this is the Wealthfront homepage. Just to be very transparent, I do not have any money currently with Wealthfront, although I am looking at it. They actually talk as well about tax loss harvesting here from the Wealthfront side. So 1.8% average boost to your after-tax returns from tax loss harvesting. Yeah, maybe. Again, same fee as Betterment. So, you know, the offset from tax loss harvesting, they say, will offset the cost of the expense ratio or the management fee here, the 0.25. You know, they'll say it covers the fee 11 times over. Yeah, depending on how much you have. You know, I don't know that I would take that as gospel. Now, if I go over here, I can actually look. When I go into Explore, again, I don't have an account set up with them yet. When I go into Explore, you can actually explore some of the areas and some of the ways that they go about investing. So let's say, for instance, I want to invest in Tesla. I can invest in electric vehicles. And again, you're not investing in individual stocks. That's not what a robo-advisor is for. It's to go through and automate your wealth, automate your investing, not pick a stock, diversify your portfolio, make sure that when something bad happens in whether it's the economy, whether it's war, whether it's a natural disaster, whether it's a housing crisis, that your risk parity is where it needs to be and you're set for the future. So you're not, you know, putting all your eggs in one basket, as I've said before. Now, that being said, you can go down here and look at all these different strategies. So inflation drivers, crypto, fintech. I would say that if you want to trade individual stocks, use something, you know, you could use Composer, which I've went through before. I think I'll do a second video on Composer because I've had a lot of people reach out to me over email asking me to do that. It's a whole other story. If you want to trade individual stocks, I'll put a link down below for my Fidelity and my TD Ameritrade. If you sign up there, but that's what I would do. I wouldn't be, you know, you can't trade individual stocks through any of these three robo-advisors, nor would I advise you to. Now, here's all the individual collections you can go through, or much like Betterment, you can go down here and you can go through the classic, socially responsible, or direct indexing. I talked about direct indexing a minute ago. Again, you need the $100,000 minimum. You can auto manage, you can personalize to your risk level. It is optimized for savings. This is probably the one that a lot of people are going to look at, the classic portfolio. And really what it does is it goes through and assesses your level of risk. Just like Betterment, just like all of them do, they want to know how much risk you can tolerate. Meaning, if things go bad, would you sell or would you buy more? When things are going great, would you sell or would you buy more? The Warren Buffett way of saying it is, if things are really bad and there's blood in the streets, what do? He buys more, a lot of people sell. Now, just logging in here and looking at this portfolio over the last, I think they've been in there almost 10 years. Yep, just almost 10 years is up almost double. So it's almost up 100%. If I move my risk level over though to 10 out of 10, it actually goes up just a little bit. Now, when I go down here, I can actually see what I'm getting invested in. So at a 10 out of 10 risk, I'm investing in VTI, I'm investing in VEA, I'm investing in VWO, VIG, VTB. These are all Vanguard. This whole portfolio is built up of Vanguard. So if you wanted to, you could go buy these individually. However, you're not going to get tax loss harvesting with Vanguard automatically unless you go through their robo-advisor. You're not going to be able to sell out of positions and go to different ETFs because Vanguard's Vanguard. Sometimes you get different ETFs in here. If I move this over, I think some of these will change. You will get some of the Schwab treasury invested funds here if you move your risk parity down and your risk calculator down. But again, much like Betterment, you've got curated by experts. You got a low management fee, so they buy and sell for you automatically and rebalance. You can do dividend reinvestment planning there. You can do tax savings with TLH, tax loss harvesting. And I did read that Wealthfront does tax loss harvesting on a weekly basis and not a quarterly basis like Betterment. If I'm wrong, please put a comment down below and let me know. The only thing I could find digging through was Betterment does it on a quarterly and Wealthfront is supposedly supposed to do it on a monthly. But again, I could be wrong. Now, if you want to go back, and if say you do have $100,000 or more that you'd like to invest, you can do that. You can go in and do the direct indexing here. I'm going to pull this up real quick. The direct indexing for accounts 100,000 or over, globally diversified portfolio designed strategically. This invests in individual U.S. stocks to enhance tax savings. And why is that important? Well, number one, if you're not holding in an ETF, you're not paying an expense ratio. If you're directly investing into those stocks, there's nothing to manage. You're buying a stock, you're going about your day. But when you pull those together like an index fund or an ETF, someone has to manage those, even if it is robotic. Now, in this case, they're just doing US direct indexing and they're putting it in a bunch of different stocks. Then they're getting you into bonds, they're getting you into developed markets, they're getting you into emerging markets, and then you've got some dividend appreciation. So, again, not necessarily a bad thing. And Wealthfront, I think, has done great. I may move some money over into it. Okay, the last one is, and it's very new, is the Webull Smart Advisor. And this just came out. I've actually traded with Webull before. So the first thing I'll say about Webull is right now it's mobile only. The management fee is 0.20, so less than what Wealthfront and Betterment charge you. The account minimum is still $0. And I would say some of the bigger ones, lower management fee and mobile only, as well as a lot of the funds inside of Webull are not Vanguard funds. I'm going to flip over to mobile now and we're going to go through this. What I want you to look at first is, if you look, here I am on the home screen. So if you have a Webull account set up, you're actually able to see it right here. So when I click on Robo, it's going to walk you through and it's going to ask you to start investing. You're going to have to sign a EULA normally, but it walks you through and it says, hey, simplicity, again, that's very normal. Peace of mind, yeah. 2-in-1 app. You can auto invest and do self-directing. Risk, balance of risk, potential return. You can do a customized portfolio, more equity, less equity, etc. And then you can look at the day-to-day. Now, if I click start investing, much like Betterment, much like Wealthfront, it's going to ask me how conservative, how aggressive do I want to be here. In this case, let's just go maximum growth, and it'll show me across the last 10 years what that would look like. So over the last 10 years, it looks like I started with 10,000 and I'm right around this 27,000. So almost a 3x return. And in this case, I'm all equities, a little bit of commodities, etc. Now, one thing I did look at on here was some of the underlying equities, ETFs that belong in this portfolio, were things like GWX, SPDW, SPEM, SPMD, SPSM, SPY. They do have SPY in there, which is the S&P 500 that covers all the equities in the 500. So I think it's interesting. Betterment and Wealthfront seem to be moving towards the more Vanguard and State Street funds that underpin their investments, where Webull has definitely partnered with Schwab, State Street, and some of the others, which I thought was interesting. I honestly thought it would just be a bunch of Vanguard in there. So when I go to add to portfolio, it'll actually ask me to complete the risk assessment, which we're going to do. We're going to go through here and we're going to say what my age group is, how much investment experience. I have extensive investing experience, how much when we need this money. Let's say I need it over 10 years. What do you do when you hear the term risk? Again, this is what I was talking about before. I like the thrill. I'm going to say I see the return. I see an opportunity for better gains. If my investment went down 20%, what would I do? I'd buy more. I really would. How do you see yourself investing? I prefer growth over stability. Now it's going to go through and it's going to analyze what it thinks that I need and what I should do. And like I said before, it goes through and it asks, hey, your risk level is maximum growth, because again, that's what I put in. But you can see the different funds in here that are underneath it. A lot of this is coming from SPY. And then of course you've got a little bit of commodities such as gold or silver. And then you have a little bit of cash. That is the breakdown on Webull. So my final comments, I think they're all great. I think depending on your risk level, your tolerance of what you can handle, Probably something like Betterment or Wealthfront's good for those in the beginning. Not that Webull's not trusted. I've used Webull to trade. It just doesn't have the track record that Betterment and Wealthfront do. But I'd be interested in your comments. Let me know down below, which one are you using and why? I've been a Betterment customer for almost, I think, a little over 8 years. Wealthfront, though, with their direct indexing, is starting to look very interesting to me. I don't really use the calls into the CFPs with Betterment too much, so that's not a big deal. And I may give Webull a try. I'm going to run a lot of their equities, their ETFs that they store in their portfolio. I'm going to run those through a couple of my analyzers and see what the expense ratios are and the drift and things like that. But if you like this, please hit the comment, hit the subscribe button. Don't forget to share. And as always, don't forget to design your financial freedom. Take care. Bye-bye.